Knowing the value of a business enables you to know what to ask for in a sell or buy transaction. This can help you to protect or even to increase your wealth. But there are a lot of valuation methods and metrics in the market, and this has caused a lot of investors not to know which one to use and when, as well as the limitations of each method. Good day, ladies and gentlemen. Welcome to Business Valuation. My name is Oscar Diura. This course will take you through a detailed analysis of the most used valuation methods. I'll also show you when to use them and how to use them effectively. Now, to start with, let's look at the definition of stock valuation. Now, this is a process of calculating the fair market value of a stock by using predetermined formulas that factor in various economic indicators. So we want to know the value of something, and we'll then have to come up with formulas that factor in economic indicators so that we determine the value. The theory behind most stock valuation methods is that the value of a business is equal to the sum value of all future free cash flows. By the word free cash flows, we are just referring to the actual money that flows into the pocket of the investor. And we are saying we want to sum up, we want to find the value of all the future cash flows that you're going to get from the business. And that should be the value of that business to you. The question that we're always asking ourselves when we're investing is, what do we get from investing in this company? So all the monetary value that you get in the future by investing in a particular company forms the value of that business to you. However, you have to understand that this is happening in the future. So we have to discount the cash flows using the time value of money method to get their equivalence value as of today. As you all understand that $1,000 received in a year's time is not the same as $1,000 received today. So these cash flows that you're going to get in from the business are in the future. So we need to discount them to get their value as of today. So if you objectively know all future cash flows of a company and you have a target rate of return on your money, then you can know the exact amount of money you should pay for that company. So what we just need to know is all the future free cash flows of the company, as well as the required rate of return by investors in the market. And from that, we can be able to determine the value of the business. If we knew exactly how much cash flow is to be generated and we have a target rate of return, we can know exactly what to pay for a dividend stock or any company with positive free cash flows, regardless of whether it pays a dividend or not. Now, the value of a share can be determined in different ways. The choice is governed by the reason for investment. So that's where most investors lose it. You need to understand your reasons for investment. Why are you investing in the company? You also need to understand the company fundamentals, the history of the company, for you to start valuing the company. And then that should give you kind of a pointer into which kind of method you can use when you're valuing a particular company. Now, the frequently used valuation methods are the discounted cash flow method, where you look at the future free cash flows of the company and then you discount them to see their value as of today. We also have the PE method. Now, this one is a comparative method where you value a business, you look at the PE of a company, compare it with the PE values of other companies. Normally, a company with a lower PE ratio is undervalued, whereas a company with a higher PE ratio is overvalued. But it all depends. So we'll look at this part in detail, as well as the discounted cash flow method. We're going to look at it in detail, and we're going to do examples on that as well. So all these methods that we're listing here, the discounted cash flow method, the PE method, we also have the dividend growth model, and this is most suitable for a company which pays a dividend, which might also not be having a share price. For example, a company which is not traded on a stock exchange. We're also going to look at this method in detail and provide workings, some typical situations and scenarios that you can first in the investment world. We're going to look at that. Other methods that you might also want to know, but we are not going to dig deep into them, is the residual income method. You also need to know there's the asset-based valuation method. In the asset-based valuation method, you are looking at the assets of the business, and then you're saying the value of the business is the net assets of the business. So you look at the assets, you deduct the debts, and then you get the value of the business. So let's meet again in the future video as we continue to explore various valuation methods. I'm very confident that this course will give you the best.